So maybe you've heard about investing from your family or friends or people in your community, or maybe you've started investing in some ways. The purpose of this session is to introduce some concepts of investing. So what does it mean to invest? What is the benefit to investing? What's the risk associated with investing? And really, what options do you have to invest? So what we'll do is we'll look into specific aspects in the investing world. The purpose of this session is going to be just to introduce these concepts. We're not going to go in great detail in any of these. However, our hope is that we're going to pique your interest to start thinking about the concept of investing and give you just enough information to kind of guide you in asking the right questions, as well as just starting to research on your own. So I do want to say before we get started in the specifics of this module that at VentureEXP, we are not investment experts, and in no way are we telling you to invest, what to invest in, when to invest, and things like that. Really, the purpose of this module is to introduce, so it's an educational module, to introduce the basic concept of investing and to help guide you on the path of determining if investing, one, is right for you, and two, how would you actually go about gathering more information. So what are we going to talk about today? We'll introduce investing, as well as introducing specific terms and concepts that maybe you've never heard of before. We'll define risk, because you can never talk about investment without also talking about the risk of that investment. Then we'll talk about how do you actually invest, the types of investments that are out there, and then we'll go into some classifications of building your investment portfolio and how you actually diversify that portfolio. So what is investing? Investing is the act of committing money. And if you see this word capital, in the context of investing or in economics, capital doesn't mean like a capital city. It means money. So capital and money can be used interchangeably. So investing is the act of committing capital to a specific investment with the expectation of obtaining additional money in return. Basically saying, if I'm investing this amount of money, I expect once this investment returns back to me, I'll get my original investment plus extra. And therein lies a worthwhile investment. Investing is different than gambling, right? So investing, there are a wide variety of different products that you can invest in, and we'll talk about those in this session, but it's very different than gambling in the way that it's structured and organized. Lastly, as a concept, investing lets your money work for you while you continue to work for your own money, right? These two things can be happening simultaneously, and through investing and through effective investing, your money can be working for you to make more money. So let's go into defining some basic terms. First, time value of money. This is an economic principle that says $1 today is worth more than $1 tomorrow. And it's because of investment opportunities, which means today you can take $1 and you can start investing it, which means overnight, just in this one small example, overnight that $1 can earn interest from an effective investment, and therefore it's more valuable to get $1 now than it is to get one tomorrow, because you can invest it and it can earn money. So this basic principle is really what all investment stands on, right? So once you subscribe to the principle of time value of money, then you can make decisions within your money, within the investment world. Second thing, inflation. You may be hearing a lot about this, in these current times in the spring of 2023, because inflation is on the rise. Inflation basically means that there's an increase in prices, and because of an increase in prices, there's a decrease in the purchasing value of money, right? So maybe you had $12 that you could go into Chipotle and get a burrito. But because of inflation, maybe that burrito now costs closer to $15, but you still only have $12. So what's happening is prices of the burrito are going up, and the value of your $12 is going down. And that is what happens in inflation times. By investing, what it allows you to do is overcome inflation over time, because you're adding interest, you're adding earnings on your money, as opposed to just holding $12 in your hand. That $12 can be earning you money out in the marketplace through investing. The next one is risk. Risk it needs to be talked about anytime you talk about an investment. Risk is the potential for an investment to lose value or to not perform as expected. We'll talk much more about risk because risk is a very important component when thinking about investing. The next one is return. Return is the earning potential from any specific investment. Whether you're investing in buying real estate, or you're buying a stock in a company, or you're investing in opening up a savings account in a bank, all of those have specific returns associated with them. The next one, returns come in many forms. One of those forms is interest. Interest can be both the cost of borrowing money and it's the cost of money earned for lending money. So first, for borrowing money, think about on your credit card, right? You're taking out a loan, more or less. When you buy something with a credit card, you're using that credit card company's money and you're buying groceries or a plane ticket or whatever it is, right? In essence, you're buying using their money. So if you don't pay it off in the specific payment terms that they say, pay off your credit card in that first month or whatever, then you're going to pay interest on that money that you borrowed. On the flip side, when you put money into a savings account with the bank, they're going to pay you interest for you giving them that money, so then they take that money and they invest it all over the place. So interest can be both on the cost side and on the earning side. Next, I want to talk about passive income. Passive income means this is money earned without your active involvement. Okay, a really good example of this is real estate. If you have an apartment, let's say, or you have a house and you're able to rent it out to tenants and they're paying you rent on a monthly basis, then while you're working your full-time job, you're also earning money from rental income, which is a form of passive income. And that's how you diversify your income streams and protect yourself from any issues. Let's say you were to lose your job for some reason, you still have other income from rentals. Or let's say the rental market were to deteriorate and you no longer have that house. Well, then you still have your job. So you're diversifying your income. The next is an asset. An asset is anything that has value that can be purchased or owned, right? So an asset, a very common asset, is a house or a car. Also, something to think about, it may not feel like an asset, but actually having money, right? Cash in your hand is a version of an asset. Then next we'll talk about debt. Kind of the other side of the asset coin is debt. So it's something borrowed for a predetermined amount of time with a specific payback term. A really good example of this is a house. You take out a mortgage, which is a loan to purchase a house, which means the bank is actually buying the house, more or less, with their money, and then you're paying off that mortgage over 30 years with, let's say, 5% interest rate, which means the bank actually buys the house. It's your house, but the bank is buying it, and then you're paying the bank back over the course of 30 years, and you're paying them back the purchase price plus the interest rate. And in that case, let's say the purchase price is $300,000 and the interest rate is 5%. You're paying the bank back for buying them. The last term to introduce is liquidity. This is the ease that an asset can be bought or sold. If something is easier to sell, it's more liquid. If it's harder to sell, it's less liquid. So take a minute to think about the liquidity between a $10 bill that you have in your pocket versus a house. A $10 bill, cash, is the most liquid because you can buy and sell that immediately, right? You can go to Chipotle and you can use that $10 bill. To go and buy a Chipotle burrito with a house is not going to be the method to do it, because a house is a much less liquid asset and it takes a lot of time for you to be able to sell and buy that asset. Let's keep cruising. So why do we invest? Well, retirement for one. We're working throughout our professional career and then we decide we want to retire. The retirement age does fluctuate, but right now it's between 65 and 70 years old in the United States. The federal government has a program called Social Security. You may have noticed, if you've worked before, that Social Security taxes are taken out of your paycheck. Well, this is a government program to support people once they actually retire to have a monthly income. However, there is some risk with Social Security because the population is living longer in the United States, and there is some talk that Social Security won't be as viable of an option for people like yourself that are younger and still have to work for many, many years before you retire. So because Social Security, although it is secure for now, and it's uncertain what it's going to look like in the next 10, 20, 30, 40, 50 years, there are other types of retirement accounts that you can look into. I've listed a few here: a 401k, a Roth IRA, and a traditional IRA. I'm not going to go into detail on what these specific retirement accounts look like, but I highly encourage you to look into these and also to ask people in your life that are already in the working world, to ask them about how they're planning for retirement, mainly because time is your most valuable asset when you're thinking about a long-term investment. So a 401k, a Roth IRA, and a traditional IRA, the longer that you have those open, and the more you're contributing money to them over time, the more valuable they're going to be. So the sooner you start asking questions, then the sooner you're going to feel more comfortable making decisions on it, and then the sooner it's going to start having compound interest, which we'll talk about here shortly. Also, why invest? Desire to increase your quality of life. If you're able to diversify your streams of income and increase the overall amount of money that you're actually making in a given month or in a given year or in a lifetime, money doesn't drive happiness, but what it does is it drives choices. And the more choices you have, then in our opinion, the more happiness, the greater likelihood you have for happiness, because you can make choices on what aspects of life do you want to decide on, and money gives you those choices. The last thing about investing is you can save for big purchases like houses and cars. You can also save for education, right? Higher education is very expensive. So your future kids, sending them to college, there are all sorts of investment accounts like a 529 fund. A 529 fund is an investment account that you can set up for your future children to support them in paying for college. Let's continue on why investing. Investing now allows for more financial flexibility for your future. So, like I mentioned, this concept of compound interest. Maybe you haven't heard about compound interest, but what it refers to is your investment that is earning interest. It is then, over time, it's earning interest on the interest that's been earned. So in this case here, we have a tale of two investors. Tanya, at age 20, she starts contributing $1,200 every single month to, let's say, a long-term investment account, like a retirement account. Then when she retires at 65, she has $246,000. For Nikki, she's at age 30 starting to contribute $1,200 a month. And in that, she's ending with $141,000. So the difference of $105,000 at the time of retirement is because of compound interest. So because Tanya is investing earlier, there's 10 more years for Tanya to be earning interest on her $1,200 she's contributing every single month. And because of that, at the age of retirement, there's more than $100,000 different. Now, $1,200, think about that as $100 per month contributed into an investment account. And that $100 a month may sound like a lot of money now, but $100 a month when you're working a full-time job and making $65,000 a year, let's say after graduating college, you might be able to increase that and even allocate more than $100 per month towards that account. And ultimately, the more you contribute, the more interest is going to be applied to your account. Now let's talk about risk. With any investment, there is risk. So risk is not just with investments, it's also just a part of life. And we have our own personal risk tolerance with everything. Maybe you are risky in, you feel comfortable traveling by yourself to a foreign country where you don't speak the language. Or maybe you feel comfortable traveling by yourself to a foreign country to a foreign country by yourself, but you want to go somewhere where they do speak your language, right? In that decision is really you determining your risk tolerance, okay? And now in the topic of investments, it's the same thing. We have a risk tolerance, and everybody's risk tolerance is different. So sometimes you don't know your risk tolerance until you actually cross that line, and then you need to find a way back to comfortable level of risk. Maybe buying a car and having an automobile loan, borrowing money from a bank to buy a car, maybe that's more risk than you're comfortable with. And it might be a situation where you don't know until you do it, and then you're losing sleep because you're uncomfortable having a $250 a month car payment, right? But again, figuring out your risk tolerance in all things, both investments and every other aspect of life, is something that takes time. And nobody can really tell you your own risk tolerance. It is something that in many cases you have to figure out. And everybody's risk tolerance is different. So within investments, let's talk about a few different risks. Well, first of all, there's market risk. An overall investment market will decline, and then the value of your investment decreases. So on a much bigger scale, everyone's investments are going down, and therefore the value of your investment also goes down. That's what we call market risk. The next one is liquidity risk. The risk that you won't be able to sell when you need to, and the value of your investment decreases. A perfect example of this is about houses. If you buy a house when prices are, let's say, high, because right now house prices in spring of 2023 are relatively high, and if you were to buy a house now and then you wanted to sell it, let's say in a few years, maybe the house prices decrease and you're no longer able to sell that house at an increased value, so you actually lose money on it. This is what we call liquidity risk. The next one is inflation risk. The risk that inflation will increase and therefore the value of your investment decreases, right? We talked about that inflation is when prices go up and the value of money goes down. So if inflation is going up, if you purchased an investment for $1,000 last year and inflation has gone up, then the relative value of that $1,000 has gone down. The last one is interest rate risk. If you buy into an investment that is impacted by interest rates, then changing interest rates will affect the value of your investment. So let's continue on risk tolerance. It's a measure of how much risk you can handle as an investor. Some factors to include are how much money do you have and how much money do you have that you're willing to lose. Secondly, what is your time frame? A really good example with this one is, what is your time frame between now and when you want to retire, right? So let's say you're 18 years old now and you're planning to retire when you're 70 years old. Then you have more than 50 years of a time frame to invest. So maybe you can take on more risk now while you're young because you have time to overcome any downturns or any decrease in value. But let's say you're 18 and you're starting an investment account to, pay for going to medical school. So maybe that's going to be in 5 or 6 years. Your time frame is much, much smaller. So maybe you're more risk averse, right? You can't take on as much risk because you don't have enough time. And then the third one is, what's your emotional ability to handle risk? Risk is involved in every decision that we make, especially with investments. And emotionally, how are you able to tolerate that type of risk? Ultimately, your risk tolerance will determine what kinds of investments you should pursue. There are investments that are low amounts of risk, there are moderate amounts of risk, and there's high amounts of risk. And each of those will have corresponding levels of return, where typically the more risk, the more return. The less risk, the less return. But again, it's not about right or wrong, it's about what's your comfortability with risk. And truly, there's no right or wrong way to invest because everyone's risk tolerance is. So what I want to do is introduce some types of investments. All right. I want to talk about savings accounts. I'll talk about bonds, which sometimes those are called debt or fixed income. 3, I want to talk about stocks. Sometimes those are called equity. Then we'll look at mutual funds, and then a certificate of deposit, which is commonly called CDs. Maybe you've heard of these. Each type of these investments have a different risk associated with them, and we'll discuss over the next slides which of these is more risky, which of these is less risky. Like I mentioned before, higher risk equals a higher potential return on investment. And again, it doesn't mean you need to take on, you need to seek out highest potential return on investment because it depends on your risk tolerance, what you're comfortable with. So note that there are many other types of investments that this module won't get into, but if interested, we encourage you to read about options, futures, Forex, commodities, and ETFs. These are many other investment opportunities. We're not going to talk about those because they're a little bit more technical than what we want to introduce in this module, but if you are interested, it might be worth looking into those as well. So first one, we'll look at a savings account. Opening a savings account, or a money market account, sometimes they're called, with a bank where you're able to access the money whenever you want, and in exchange, the bank will give you a small amount of interest for giving them your money. So maybe you have an account with Chase Bank where you have a checking account and you have a savings account. And in your savings account, maybe you have $1,000. So on a monthly basis, you notice that Chase Bank is depositing into your account like maybe 1 cent or 2 cents or maybe even 5 cents into your account, depending on the interest. So it's a pretty low return, but it's an extremely low risk investment because you're opening up a savings account, you're giving your money to the bank, but you're able to access that money whenever you want, right? You can go to an ATM and pull it out, and that money is insured by the government under something called the FDIC. So this is a highly liquid investment since you can access the money whenever you want, and in exchange, it's a very low return, right? If you have $1,000 in there, let's say you're getting 5 cents every single month. It's not nothing, but it's not a big investment with very high return. Next, let's look at bonds. Like I mentioned, this is called debt sometimes. So think of you are the investor and you're buying a company or a government's debt that company or government guarantees they will pay the investor back with under a specified amount of time and an interest rate. So some types of bonds are corporate bonds. Think like Microsoft company. Then there's municipal bonds. Think, Boston, Massachusetts. So a city or a state or even a township, they're able to issue municipality bonds. And then the last one is the U.S. Treasury bonds. So this is the federal government. And the federal government's U.S. Treasury bonds, they're considered the least risky investment that's available. So with bonds, they're a moderate risk since you are getting consistent returns through interest payments from the company or government that is borrowing the money from you. And they're less risky than stocks because you aren't actually an owner of the company like you are with stocks. So if the company fails and you're a bondholder, the company is obligated to pay back their bond investors. So you're taking on much less risk than a stockholder is of a specific company. And return will vary based on the investment rating of the company. So we're not going to go into details here, but there are investment ratings of companies. A company like Johnson & Johnson is a AAA rated company, which means it has the highest rating, which means it's the safest and least risky company to buy debt into, to buy bonds from, versus Facebook, where they're a BBB plus rated company, which means they are more risky relative to Johnson & Johnson. So again, we're not going to go into the full ratings of investment companies for buying into debt and buying into bonds and stocks. But I do, again, just want to give this little nugget of info that there are rating agencies out there that categorize companies based on the amount of risk. So we talked about stocks, now let's get into it. Stocks is probably, if you've heard a little bit about investments, you've probably heard a little bit about stocks. So what stocks are, and sometimes they're called equity, is ownership in a company in the form of purchasing shares of that company, right? So that company is opening it up to the marketplace to say, we need to raise money, we need to raise capital, and therefore we'll give up pieces of ownership of our company. So individual investors can buy pieces of that company. Now, stock prices are going to fluctuate on a daily basis, and the basic concept for stocks is to buy low and sell high. So if you can get into an organization that you believe in, that ultimately you want to get in when their stock price is low and then sell it when the stock price is higher. So companies issue stocks to raise money, and you as the investor buy those stocks if you believe in the company's long-term growth potential and value. So if you like Apple company and Apple like computers and iPhones and things like that, and you think that over the long term they're going to continue to grow and their value is going to continue to increase, then that might be a stock to consider. And again, I'm just referencing that as an example, but individual companies like Apple will issue shares out there and you can purchase those stocks. Stocks are a high risk since the investor loses the investment if the company goes out of business. And there's no guarantee that the company will ever give you any returns on your investment. Sometimes companies will pay something called dividends, which basically means people that own shares or own stock in a company, sometimes the company will issue dividends, which means they'll pay you for being an owner and for lending them money. But there's no guarantee. The companies are not obligated to share dividends and share profit with their investors. Okay, let's keep going. Next, we want to talk about mutual funds. This is an investment that consists of a pool of funds contributed by many investors that all have their money combined to invest in stocks, bonds, and a wide variety of other investment assets. Mutual funds are managed by professional investors, and those people are called money managers. So basically, they're managing a mutual fund where they have hundreds or thousands of individual investors that are giving their money to this money manager, and that money manager is then deciding what they want to invest in. So a mutual fund, the risk ranges from moderate to high risk because of the diversification of exposure, but varies from fund to fund. Some mutual funds are going to be more risky than others depending on what the money managers are investing in. Another thing to consider is that many mutual funds do charge management fees. For that money manager who's actually managing that investment account for those thousands of investors that have all given them money, they sometimes do charge management fees. The next one is CDs. This is similar to a savings account, but it is an account that holds a fixed amount of money for a fixed amount of time in exchange for a fixed interest payment. Maybe you've heard about CDs that are 6 months or 1 year, 5 years in length. The general principle is that the longer the time commitment, the higher the interest rate of return will be that is guaranteed by the bank. So banks are going to put it out there and say, we'll offer CDs. If you give us this amount of money for 1 year, then we will give you this amount of interest back at the end of 1 year. Now, this is a lower to moderate risk of an investment, and there is a higher return than a savings account, but it is less liquid because you can't access the money until the time period is up. So if you give a bank $1,000 for a 1 year CD in exchange for 5% interest, so you'll earn 5% interest on your $1,000. So at the end of 1 year, they'll give you not $1,000, but they'll give you $1,050. And during that 1 year period, you're unable to access that $1,000. So if we compare that over to a savings account, you can put $1,000 in there. Maybe they'll pay you a few cents every month. So at the end of the year, you've earned much less money. Throughout the year, you've been able to access that money. So again, it's up to you to decide what is your risk tolerance. If you're giving up that $1,000 for a year, can you afford to not have access to that with the opportunity of making $50 versus making $1? The next thing we want to talk about is investment portfolios and diversification. So ultimately, your investment portfolio is the total grouping of all of your investments, which balances your both risk and your return, right? So it's important for long-term goals, especially in your retirement, to diversify your portfolio. What we don't want to do is put all of our eggs in one basket, right? Where you're depending on the success or failure of one specific company that will decide your ability to retire at some point in life. So diversification really is a risk management tool that mixes the different types of investments within your specific portfolio. And that means if one part of your portfolio decreases in value, maybe other aspects of your portfolio will increase to offset it. So yes, maybe you're making less money, but you're also losing less money. So what you're doing is you're kind of hedging your bet, right? You're saying, I'm going to invest because I do believe in long-term growth, but I don't want to risk all of this money. And that's really where diversification comes in. So your specific portfolio diversification will likely match your risk tolerance and your timeline. So you'll see in many of those retirement accounts that we talked about, they'll have things called target funds. And a target fund means if you're targeting a specific year of retirement. So if you're planning to retire in 2063, maybe you invest in a target fund of 2063. And in that target fund, earlier on, so here in 2023, maybe the mutual fund or the fund is going to invest in much riskier assets because you have more time to make it up. Whereas when you get closer to 2063, it's going to get less and less risky because you will have less time to make up any losses, and therefore you're going to need that money sooner than later. So just thinking about it in terms of diversification within your risk tolerance and within your time. So now, to kind of wrap up this module, time is your most valuable asset because of the miracle of compound interest, which is your money earning money on the money that it's been earning. And that's what compound interest is. Before you make any investments, we strongly encourage you to understand both the risk and the opportunity of every investment that you're considering to ensure that you're making an effective decision. And we do think it's valuable to lean on people in your network, whether that's professors or teachers or family members or people in your community, or maybe it's, if you don't have any of that, maybe it's enrolling in courses that can teach you about personal finances and things like that. Use your resources, and none of these decisions should be taken lightly because it is a big decision. There's big opportunity, but there's big risk.